So welcome to this video. In this video, we are going to discuss about the topic economic environment. So this chapter majorly concerns about macroeconomics. So we'll discuss about what is macroeconomics and we'll keep moving. So macroeconomics is a branch of economics and which studies how the aggregate behavior of a economy works. So it helps in understanding how the government works, or in the printing of the money, the inflation, all those things it is like concerned about. Macroeconomics helps to understand a wide economy-wide phenomena such as inflation, price levels, rate of growth of a country, national income, GDP, and unemployment. So these are the areas which macroeconomics focuses on. So the objective of macroeconomics is to provide full employment for the country. The price should be stable, that is, the inflation should not go very high. The economic growth should be at a high rate. The balance of payment should be maintained, that is, the export and import should be maintained at a equilibrium point. The exchange rate between country should be maintained at a stable rate. So it should be brought to a level which is favorable to a country, but still the stability is much more important. And finally, it also should help in achieving social objectives. So these are the objectives of macroeconomic policies. So how does a country achieve its macroeconomic goals? So there are two ways to achieve macroeconomic goals. So one is through fiscal policy and the other one is through monetary policy. So we'll start discussing about fiscal policy. It refers to government spending policies that helps to achieve the macroeconomic goals. So whenever the government tries to push the economy or to uh, slow down the economy by through its policies, that is called as fiscal policy. So through fiscal policy, regulators attempt to improve unemployment rates, control inflation, stabilize business cycles, influence the interest rate in an effort to control the economy. So it is all about the government's policies through which it is being done. So it was introduced by a person called as John Maynard Keynes. Okay, so he introduced the concept that governments should come and intervene in the macroeconomic operations, and they have to adjust the growth of a country. So how does the government influence the macroeconomic goals? So they do it through expenditure, revenues, and borrowings. So expenditure in the sense government will build a lot of roads, ports, or airports. So by spending on all these kinds of infrastructure facilities, the government creates a kind of a pushes the money into the people's hand, and it also helps to achieve the social objectives of a country also. They also do it through changing the tax rates. So if the country is like growing slow, if the country is growing slow, the tax rate would be reduced, tax rates would go down. If the country is growing very high, then the country can also increase the tax so that the growth also comes a little bit down. So through revenues from taxes, they can try to control the growth of a country. So they can also borrow. So if they don't have money on their own, the government can also borrow it from the money market, and they can also spend it in the infrastructure developments. So they can borrow money and they can spend in the expenditure. So these are the ways in which governments can activate growth. So monetary policy is concerned about the actions of a central bank that determines the money supply in a country, which can indirectly affects the interest rates in the country. So monetary policy is an indirect way of stimulating or stopping growth in a country. So monetary policy is maintained through actions such as increasing the interest rate or changing the amount of money banks need to keep in their reserves. So there are like few ways in which the central bank of a country can control growth. So we'll start with those kind of tools. So one is the interest rate. Okay, so the banks have the power to set the interest rate in many countries. So by setting the interest rate, they try to control the growth of a country. So for example, if a country is growing slow, okay, the growth is very slow. So if the growth is slow, the central bank would reduce the interest rate. So once they have reduced the interest rate, the money supply goes higher, and as money supply is higher, there will be more activity. So activity in the sense, factories will develop, interest rate is cheap, so people will buy more items and goods, and this in turn will increase the growth of the country. So growth will now be high. So this is how the governments try to influence the growth of a country. It can also work in a vice versa. So normally the central bank is a custodian of the conduct the monetary policy. So they have the power to raise or lower the interest rate, and they can target a particular interest rate in a country. So they have the power to raise or to lower the interest rate. But there's a problem here. If the central bank is going to reduce the rate too much, okay, and there's a problem that if it goes to zero, they cannot go below zero. So if the interest rate is 10%, to boost the country they can reduce it to 5%, but to still boost they can go to up to zero, but they can't go to something called like -2% and all. So that doesn't work. So that is the called as a liquidity trap. So the second tool that the central bank has is open market operations. So we'll discuss about what is open market operations. So open market operation is a controlling of the money supply in a country. So if there is a high amount of money supply, that will lead to lower interest rate. That will lead to lower interest rate. And if the money supply is low, then that will lead to high interest rate. Okay, so by controlling the money supply, the interest rate is controlled. So in countries like US, they don't control the interest rate, but they try to control the money supply. So how do they do it? So we'll take the central bank. The central bank sometimes buys bond. By buying a bond, what would happen? The bond will move from the money supply market, and the cash will move from the central bank to the money supply. In the money supply, as it's more higher, that will lead to lower interest rate. So this is how it works. You can also put it on the other side. You will get the high interest rate. So purchasing the bonds will inject money into the banking system. That will stimulate the growth, while the sale of securities do the opposite. So just now we've discussed about it, and that's how it works. So we'll move on to the next tool. It's called as reserve requirements. So reserve requirements works like this. Every bank operates on deposits. So assume that you deposit 100 rupees, that goes to the bank, and the bank gives it as borrowing. Okay, the same 100 rupees. So what happens is the bank creates a kind of a reserve here. Requirements regarding the amount of funds that banks must hold in reserve against deposits by their customers. This money must be in the bank's vaults or at the closest Federal Reserve Bank, also known as required reserves. So assume you have deposited 100 rupees, the bank cannot lend the same 100 rupees. Okay, from here on what would happen is there's something called as a reserve. So this reserve would be like 20 rupees. So the bank can effectively give only 80 rupees as the borrowing. So by increasing the reserve, assume the reserve goes to something like 30, then the borrowing, that the money that can be lent is only 70. By increasing the reserve requirements of a bank, the central bank can easily control the money supply. So this is again a kind of a tool. So higher reserve requirements makes the bank to hold more reserves, taking out the money out of circulation. So if you have set the reserve at 30 rupees, only 70 can be lent. If you have the reserve at 10 rupees, then 90 rupees can be given as borrowings. So that's about the reserve requirement. Lower reserve requirements makes the banks to hold less reserve, injecting more money into the circulation. So that's about the reserve requirements. We will move on to the next topic. So you can go through this question. It's from the examination December 16 or September 16 exam. Which of the following government actions, fiscal and monetary, could lead to an increase in aggregate demand? Okay, so increase in aggregate demand means there's more money supply in the market, or so that is the concept here. Increasing taxation, if you increase taxation, then money is withdrawn from the market, so that is a wrong choice. Decreasing taxation, yes, people have more money. Increasing government expenditure, yes, if government spends the money, then uh, the citizens in the country will get that money. Decreasing money supply, no, our job is to increase the aggregate demand. And last is decreasing interest rate, yes, if we decrease the interest rate, people will borrow more money and there will be more money supply. So we will check the answer. The answer is C. So 2 and 4 are the right options. So C is the answer. So there's one more question. This question has appeared in December 2014 exam, and we can go through this. Governments have a number of economic targets as part of their fiscal policy. Which of the following government actions relate predominantly to fiscal policy? So which of the following are part of fiscal policy? Interest rate is a monetary policy. Taxation is a fiscal policy. Using official current foreign currency reserves to buy the domestic currency, no, again that is a monetary policy. Borrowing money from the capital market and spending it on public, yes. So 2 and 4, C is the fiscal policy. Yes, answer is C. So now we'll move on to the second part of the chapter, which is called as competition policy. The main aims of competition policy is to promote competition, make markets work better, and contribute towards improved efficiency. So competition policy helps to ensure that there's more good, healthy competition among the companies. So it's not like one company is predominantly having more power over the other companies, or there's some kind of a hoarding happening, or the price is being controlled, or some kind of a oligopoly structure is like created. So competition policy ensures that anything which is against free market system is reduced. So in India, we have a policy like this. You can read this on your own. So what are the tools through which competition can be made healthy? So one is avoiding market failure. Two, the country could bring more deregulation. And last is privatization. So we'll start from market failure. So what is a market failure? Market failure is if the government does not involve in the operations of a company or doesn't regulate them a lot. At one point of time, what happens is they do stuff they do things which are actually bad to the country and to the citizens of a country. So that is called as market failure. Market failure can be viewed as scenarios where individuals' pursuit of pure self-interest leads to results that are not efficient, that is, that can be improved upon from the societal point of view. Okay, from the societal point of view, it is really bad, and but still the companies will go and do it. So that is what market failure is. So we'll see a few examples of market failure. So one is negative externalities. Okay, externalities refers to uh, the unintended consequences which happen uh, which the company even never tried to do it, but still those things are occurring. Okay, so that's called as externalities. So sometimes a company might promote cigarettes, but cigarettes might cause cancer. That is a kind of a negative externality. So cigarette companies are predominantly aiming to sell more cigarettes, but that causes cancer. So somewhere government should come here and prevent this kind of problem. Two, less production of merit goods. Merit goods are good goods. For example, people don't know the value of the good goods. So what happens is they don't buy it. And as people are not buying it, the companies won't sell it. So for example, in some countries, they feel education itself is not worth to be pursued. So what companies do is companies take uneducated people as laborers at a lower rate rather than telling them go and learn. So that can be a kind of problem. Or production of demerit goods, things which are hurting the citizens. People underestimate the cost of goods, for example, smoking or even liquor or alcohol or monopoly power. If one of the companies get monopoly power, then they can control the market and they can set the higher price. So these are the problems of market failure. So we'll move on to something called as deregulation. So deregulation is when the government reduces or eliminates industry restrictions to improve the ease of doing business. So regulation means there is a constant check on the companies, and the companies have to follow the rules and regulations of a country. So deregulation means the number of rules to be followed is like totally reduced, or they are reduced to up to a level. So that is what is called as deregulation. The government removes a regulation when businesses complain it interferes too much with their ability to compete, especially with foreign companies. So consumers can also ask for a deregulation. So governments can actually can repeal a law which is regulating, or the agency which is promoting, which is there to regulate the government, can there to regulate the business, they can remove the regulation. Or third, the agency can stop following the law. Okay, so these are the ways in which deregulation can happen. So what are the good things about deregulation? It improves competition, the quality of product becomes good, the price is reduced as there's more amount of there's a, as there's the as the regulation is less, there will be good competition, more people, more companies will start in business in the same category, and there will be improved competition, quality of product or service will be higher and price will get reduced. It allows more innovation because there's good competition, so there will be more innovation. It allows the free market to set the price. As more competitors are there, the price will be a much more fair price. So what are the bad things about having deregulation? If the if if uh, if the industry is not regulated, that would lead to asset bubbles being formed. For example, there will be very high growth and finally that will create crisis and recession. So periodically the government has to check industries regarding their growth. In some industries, okay, if there's no regulation in some industries, that will create a lot of problems. For example, in certain high infrastructure, initial infrastructure cost industries such as electricity and cable, what happens is government creates rules just for one company to operate in a particular area. For example, if you take the electricity board in Mumbai or the electricity board in Kolkata, there is like just one company which does all the electrical activities throughout the city. So there is a regulation that only one company should operate. So in those areas we need regulation. So we can't say that five companies can come in and become a electricity company. That is not like possible. So we need regulation there. It exposes people to fraud and excessive risk taking by companies that will do anything to gain profit. If we don't keep checking people and if we don't have proper regulations, then the self interest of people will lead to higher risk taking, and the companies might get collapsed. And if things are not regulated properly, then social concern is also lost, where the price of the product which is essential might be like charged at a very high rate, and still government cannot do anything. So this kind of problems are there when we have a when we have deregulation. So we'll go through this statement. In relation to Redacco, which of the following statements about competition and regulation are deregulation are true? Increased competition should encourage Redag to reduce cost. If deregulation is there, it leads to increased competition, and they will try to reduce the cost because the number of competition is higher. This is true. Deregulation will lead to an increase in administrative and compliance cost. No, because that will actually get reduced. Deregulation should mean an increase in economies of scale. No, because there's more competition, so economies of scale might not be possible. Deregulation could lead to a decrease in the quality of Redux products. As government is not checking the quality of a product, there can be a problem that the quality might suffer. Okay, because the products are unchecked in nature. So we'll see the answer. Answer should be 1 and 4. 1 and 4 is A. So that's about A. So we'll move on to privatization. So privatization is like very simple. Privatization is implies induction of private ownership in state-owned enterprises. It is a process of transferring ownership of a business from public sector to the private sector, which usually operates for a profit. Okay, so anything that is owned, any company that is owned by the government will be like owned by the private sector. So examples are most of the big airports in a country are like privatized. Bharat Aluminum Company, Hindustan Zinc, even the Maruti Suzuki Company, VSNL, all these companies are privatized companies where the ownership of the government is like quite less and the private participation is quite high. So which of the following are usually seen as a form of market failure where regulation may be a solution? So when do we need regulation? When there's imperfect competition, we need regulation. When social costs or externalities are higher, we need regulation, something like cigarette companies. When there's imperfect information, we need regulation. So answer is D. So externalities are costs, okay, or benefits which are not paid or received by the producer or the consumers of the product but by other members of the society. So for example, you smoke but other people get cancer. You consume alcohol but your family gets affected in terms of mental health. Okay, so what happens is the company produces the item but it creates an unintended kind of problems, and that is called as externalities. But sometimes it can also be positive. Okay, something like a school offering an education service, that is also creates an externality where the student over a period of time he learns well and he creates more income for the country and for his family. So anything which is unintended consequences, okay, which is created by a company is called as externality. So we have to look at in terms of green policies. Okay, so whenever a project is being like valued, a company should also take into consideration the externalities. For example, a cigarette company should also take the cost of uh, the cancer that it is creating. So and then they have to feel whether they have to create another factory or not, because the externality cost would be actually much more higher. So it is so higher that cigarette companies should by themselves stop producing cigarettes, but that doesn't happen. That's the failure in externality. For example, river pollution from various manufacturing processes. River pollution is created by the company but they don't pay anything for that. Or motor vehicle emission which is caused by two-wheeler companies. Okay, or air pollution and the health hazards which are caused by two-wheeler companies doesn't come under their consideration at all. As these are problems, the government has to step in and they have to create policies. For example, for river pollution, they have to create strict regulations. Again, for motor vehicle emission, the government creates a taxing system. So based upon the vehicle's capacity, they create a tax. Okay, so that's how it is being done. So externalities are created by companies, and they are tried and they are like prevented by the government through regulation and taxations. So government assistance. So government not only penalizes bad companies, but they also try to help good companies. So good companies are those uh, which helps in the political and social objectives of the company of the government. Any company which helps in the political and social objectives of a government will be like helped by the government. So how do they do that? They do by boosting the enterprise, speeding the urban renewal plans, training the labor force. They encourage innovation. They give support to slow growing industries. They sponsor research. They also give financial support. They also give expert advice and information. So government also helps very useful industries, something like agriculture or in education. They come and help. So thank you very much for watching this video. We'll meet in the next video.